I had a client once who had a piece of real estate worth $5 million and he woke up the next day and it was worth $500,000 of no fault of his own. I have another client who came during COVID with too many equities and closed-end mutual funds that were down 40%, yet he needed income and had to sell. Which one of those actually had risk? Hey everyone, I'm Andrew. I'm a CFA Charterholder and CFP professional who spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. I'm also the owner of Lever Wealth Management, which is a financial advisor for people who scare financial advisors. And what I want to do today is discuss the difference between those two and maybe help you perceive risk in a different way. Let's start with the client who came during COVID. They needed income. They were coming from another advisor, and that advisor had them in a growth portfolio and then in some municipal bonds that were closed-end funds. And I'm not going to get into closed-end mutual funds today. Some of them are fine. This one had a lot of leverage and was very expensive and was down 40%. And so this client comes over and they go, hey, the market's down a lot. I'm freaking out. I need income though. What do I do? And the answer is, if you need income and you don't have reserves elsewhere, we have to sell, right? The cardinal sin of investing, selling when the market's down. Unfortunately, because of lack of planning around timing issues, had to. However, this other person had a very nice piece of real estate and then the next day wakes up, and I'm not going to get into why the piece of real estate got devalued so much. Just understand it did. And it's worth it. It lost 90% of its value overnight. Client A is what my industry defines as risk. Volatility. Client B is what I would posit had actual risk. We use volatility as a measure of risk in investing because it's quantifiable, and we want to be able to quantify it so that we can make mathematical and logical decisions. The problem is, and I've said this in other videos, finance is a social science. It's not a hard science, and the math breaks sometimes. Now, the issue here was not that the client necessarily had only bad investments. The issue here is a timing issue. Volatility was a bug for them, not a feature. However, if you increase the time horizon, that's not a problem anymore if you've done proper asset liability management. You've heard me say in other videos, your consumption is a liability, your future consumption. You need assets to meet that liability. I have a preference for bond ladders to meet that liability. You're not taking undue interest rate or duration or spread risk. You've lined up a good high quality asset with a liability that you know is going to come to fruition. Then you don't wake up with the issue of, it's March 2020. My investments are down 35%. What do I do? Because I still need to pay the electric bill tomorrow. Okay. This client B, had real risk. Real risk is the risk to principal. It is not timing risk. It is not credit spread risk. It is not duration risk, interest rate risk, market risk, counterparty risk, geopolitical risk. Risk is the loss of principal. That is a hard thing to quantify in investing. Therefore, we don't define risk that way. But risk is truly the chance of having something bad happen that makes you lose your money. There are many different sub-risks that pull into that, but that is the actual issue within investing. And so when you define it that way, then you start to make retirement decisions different. You do not get 10,000 chances at retirement or 1,000 chances like your Monte Carlo. You have an N of one, as they say. You get one shot at this. If we're going to, in an overarching way, define risk as the loss of principal, we then need to mitigate what we can for that to not be the case. And when you have had investment markets that have outperformed any legitimate retirement modeling you should have done over the last 2 years, you then look at your portfolio and say, were there certain goals that I had a low probability of actually achieving that I now have a average to high probability of achieving? And you run the model based on that. And then you say, should I rebalance my portfolio? You don't allow the idea of volatility in the way we typically define risk, make that decision. Instead of looking at standard deviations, look at your N of 1 and understand that true risk is losing your principal because something that you have not anticipated happening has happened. And that therefore reduces the likelihood of you achieving your goal, which is a successful retirement. And success looks different to everybody, but I would say every person I've met with defines success as not having to eat cat food when they're 68 years old. So I wanted to start with defining that before we get into more tactical solutions. And I thought that was a good way to start this discussion on how we invest when the market's at an all-time high. Until next time, thanks everyone.